Hi all and welcome to this week's Symax Fintech report. First of all, our disclaimer as usual. So trading involves potential risk of loss of capital and is not suitable for everyone. Hopefully it is for you. Many companies provide leverage, so just be aware that you can lose substantially more than your initial investment. The views, opinions, all the information contained in this is provided solely for educational purposes and does not constitute investment advice, and we're not encouraging you to trade or invest. That has to be your decision. You should carefully consider the risks, your financial situation, definitely your level of experience and risk appetite. You should only risk capital you are prepared, but more importantly, you can afford to lose. Any doubts whatsoever, seek independent financial advice, preferably before you risk your capital. Very important. Okay, so let's start with what happened last week. So Pelosi visited Taiwan. China wasn't very happy about that. They responded by doing military exercises all around Taiwan and in the China Sea afterwards. Is it over? There's possibly more repercussions to come yet. So we had rate increases from the Royal Bank of Australia and the Bank of England. Both of them put rates up by 50 basis points. Jobless claims increased again. Just keep an eye on that. That is starting to pick up, and it doesn't really sort of relate properly to what's going on with NFP as we saw on Friday, because NFP was more than double what was expected. But I would like to point out that over 300,000 of those new jobs went to women. Data-wise, PMIs were mainly lower except for Japan. ISM was lower as well, along with manufacturing. It seems to be more services than goods that are in demand at the moment. OPEC Plus increased by 1,000 barrels a day. If they can, I think they're really maxed out on the amount that they can produce at the moment, and this is one of the problems. But it did take the oil down a bit further, below $90. But again, I think that's more because there's concerns about recessions on the way rather than OPEC increasing supply. Earnings were mixed, and that's probably going to be almost the end of earnings now. It's going to be interesting to see how this third quarter goes. To be honest, I'm not expecting too much. The US probably better. Europe and the UK, I think, are going to struggle, possibly along with Asia. So key data this week, there's not too much out really, but obviously for the US, we've got the inflation data, so CPI and PPI and Michigan sentiment as well, which is always a good one. In the UK, GDP, so after the Bank of England's comments last week, that's definitely worth keeping an eye on. For the EU, industrial production, how are they faring, especially with obviously the war still ongoing and impacting Europe heavily. And China trade reports and inflation data as well, CPI, PPI. The macro outlook. So inflation is still there. It's not disappearing. Hopefully, it's topping out. In the UK, I doubt it though. We could see inflation definitely above 10% by beginning of next year, if not before. We might even see 12 or 13%, and a lot of that is being created. Not so much from demand, but from energy prices, especially electricity prices, because in the UK we have a cap, but that cap keeps increasing so that the consumer keeps paying more towards the cost of the electricity. So strong data, expect sort of probably US core inflation to be around 6%. We always look at the core because it's more of a stable number. Shrinkflation, stagflation, recessions are still highlighted, Still potential for those. Shrinkflation's always with us. We're paying the same money, but we're getting less product for that. Supply chain issues. Now, it's interesting because they seem to be easing just a little bit. Microchips had their 6th straight month of lower demand. China lockdowns are still ongoing just purely because they've still got their zero COVID in place, their policy. So, and COVID cases are increasing again. So, they're going to be even more nervous. And this is one of the unknown factors for the macro outlook going forward. We're planning all of this and talking about all of this, recessions, rate rises and everything, as if COVID has disappeared and it doesn't exist anymore. Well, it's still there in the background. The question now is it going to come back as we move towards winter again? At the moment we're enjoying the summer months, but there's still a slight increase in cases. Now, is that going to really come back with a vengeance? And is it going to mutate and become something nasty again, like the Delta one, or is it going to remain mild like the Omicron? If we had that crystal ball to know that, it would be amazing, but we don't, so we're going to have to wait and see on that. The Russian invasion of Ukraine has sort of just gone quieter, hasn't it, really? We don't hear so much about it. There seems to be some grain movement coming out, which is great. The world needs to be fed, and they are massive exporters of grains. But there just doesn't seem to be any progress, and you don't seem to hear so much about it at the moment. Energy and food inflation are dropping. Now, when I say that, food inflation is dropping. It's dropped the most since 2008, the subprime crisis, and it's now back to pre-war levels. That is not being reflected with shop prices, though. So these companies are profiteering from that. They're not prepared to drop their prices, and they won't do that until demand goes down. And the United Nations Food Index, which is again a good one to watch, for the 4th straight month there has dropped. So it peaked at about 169 and it's down to about 141 now. Oil was trading below $90 towards the end of last week. Gas prices are still got that upward pressure just because Russia won't turn on the taps. There is about a 20% supply coming through at the moment, but as we know, that could be turned off tomorrow. It's not giving Europe enough chance to build up their supplies for the winter. US gasoline prices peaked at $5. They're now back down to just over $4. As it's the driving season in the US, that will be well appreciated. It would also give households a little bit more money in their pocket as well. There's still that lack of workers. Earnings pressure continues. US unemployment was back to its lowest level of 3.5%. It was amazing, wasn't it? Double the number for NFP. But, as I mentioned, over half of that was women. Now, obviously, that's great to get those women back in. Why are they going back to work, though? Is it because the household is struggling, because of inflation, or what other reasons are there? Now, some countries are heading for recessions. UK, most certainly. Even the Bank of England confirmed that. And the EU, I reckon, as well. We've just got to, just because of this issue we've got with gas, and it is really spiking up inflation. Food pressures coming off a little bit, but as I say, and until that demand starts to drop reasonably, we're not going to see that reflected in the prices. If we cut buy-in, then obviously they're going to have to drop their prices to attract us to come back in and buy again. Now, a few other things is, so the RBA, they put their rate up, so they're at 1.85% now. The Bank of England Yep, they put their rate up to 1.75, but they forecast a recession by the end of 2022, and they expect it to last at least 5 quarters, so over a year. Now, the NFP came in at 528. As I say, it was over double what was expected, which was a big surprise. PMIs, UK, US and China disappointed. Now, personal spending in the US is lower. Now, I mentioned this earlier, but it's more on goods, but it's higher on services. So there is still spending in the US. But of course, a lot of that is probably coming from, the people that have got steady middle to high incomes, not the guys at the bottom that have got the more basic incomes. So they're struggling more, as you would expect, just because inflation's so high, and their salaries probably haven't gone up, or certainly haven't gone up as much as they need to compensate for that. And well, as I say, there's not too much. I mean, the gasoline thing is good. Now, the other thing that I want to mention is Biden's Build Back Better. Now, he's almost got approved for a $370 billion stimulus package. Stimulus is probably the wrong word, but it's exactly what it's going to do. It's going to stimulate even more than the economy already is at the moment, and it could get passed soon. A lot of that includes sort of clean energy incentives around solar, electric vehicles, heating pumps, battery storage systems. But of course, all of that again is going to drive up the demand for electricity. And of course, surprise, surprise, within that Build Back Better, there are no tax hikes for the rich. And of course, he's got to bear in mind, and he's really focusing now, I would guess, on November, because that's when the mid-elections come. And at the moment, the voters aren't going to be very happy because of inflation being so high. So what he can do about that, I don't know. The central banks are going to be meeting at Jackson Hole 25th, 27th of August. All the central bankers, economists and all that, they all have this big meeting to discuss what's going on in the world. Maybe it's not such a joyful occasion this time round. Now, bonds, I think, are becoming more attractive than stocks. And with rates going up so high, stocks becoming a little bit more uncertain, especially if the US and other countries continue to be more aggressive with their rate increases. So just hope that gives you a little bit of insight of, what I think is going on with the macro picture.